Hello everybody. This is lesson 24 of the lecture International Economics. I will present slides 28 to 49 of chapter 4, International Financial Crisis. We will talk about the stock market crash of 1929 and the resulting world economic crisis of the 30s of the last century. From the year 1920 to 1929, the US economy and the economies of many other industrialized countries experienced a period of fast economic growth called the Roaring Twenties. Several factors favored this development. First, the economic aftermath of World War I were overcome in most countries. The world economy was enjoying a period of relative stability. International trade started to regain momentum. A lot of new technologies spread. Households became connected to the electric power grid, and this had very similar effects as the connection of households to the internet in the 1990s. New products such as electrical household appliances, kitchenware, telephones and radios could now be sold to households. The principles of mass production developed by Henry Ford made production costs of all these products considerably cheaper. New industries emerged, fast growing, like the automobile industry, aviation industry or the film industry. All these new technologies unleashed investor fantasies about new profit opportunities. New stock companies were founded and sold on the stock market at great profit. More and more people became attracted to the stock market and started investing in stocks. This diagram shows the development of the so-called Dow Jones Stock Market Index during the Roaring Twenties. The Dow Jones Stock Market Index is defined as the average value of the 30 largest stock companies that are traded on the New York Stock Exchange, also known as Wall Street. The technological progress just described caused higher profits for the stock companies, so that the prices continued to rise with the beginning of the 20s. This led to speculation on further price increases, so that the demand for shares continued to rise in the course of the 20s. This diagram shows the development of the average company earnings per stock of the 500 stock companies included in the Standard & Poor's index. This index covers the 500 largest companies that are traded on the New York Stock Exchange. This strong upward trend in corporate profits in the course of the 20s gave rise to further profit growth expectations. This chart shows additionally the average stock price of the 500 companies of the Standard & Poor's index. It is given by this blue line here. The green line shows again the development of the average earnings per stock of the Standard & Poor's index, however now on the same scale here as the development of stock prices. The difference makes clear that stock market prices had been growing much faster than the development of earnings per stock. If you divide the earnings per stock by the stock price, the resulting number is called the price-earnings ratio. As this diagram shows, the price-earnings ratio rose very sharply during the 1920s. This implies that stock prices had been growing much faster than the earnings of the stock companies. With the stock market crash of October 29, stock prices began to collapse, such that the price-earnings ratio also collapsed. The diagram shows that there was a similar development in the 1990s, which finally led to the bursting of the internet bubble in April 2000. The American Central Bank, the Federal Reserve, as well as major European central banks, injected a lot of money after World War II and in the course of the 20s into their economies. This led to an increased creation of money-backed credits by the commercial banks of these countries. The red line in this diagram shows the development of American money supply. As is observable, there was a sharp increase in money supply immediately after the end of the First World War. The green line shows the development of the nominal GDP, while the blue line shows the development of the real GDP. The growing difference between the green and the blue line over the 20s implies that this type of monetary policy caused first a strong inflationary increase in the prices of goods. In the course of the 20s, money growth became stronger than the growth of nominal GDP. This indicates that a part of money supply was now not flowing in the demand for goods, but in the demand for stocks, a phenomenon which is called asset price inflation. The increase in credit supply flew in part to private households as consumer credits and in part to investors. Consumer used credits to buy all the new available consumer goods like radios, refrigerators, kitchenware, cars, and so on. Many firms made therefore large profits. Investors used credits to buy stocks of these new technology corporations. Newly developed investment funds offered shares to normal households which had so far not invested their savings in stock. The supply of cheap credits induced even average households to buy stock financed with credits. The resulting expansion in the demand for stock led to a boost of stock market prices in the 20s. Between 1925 and 1929, the Dow Jones Index grew from about 100 to 380 index points, which implies a yearly growth rate of nearly 40%. For example, the share of a newly founded stock company called Radio Corporation of America had an initial value of only $5 in the year 1925. It reached finally a value of $500 in the year 1929, just before the stock market started to crash. This corresponds to a yearly growth rate of over 200%. In summer 1929, the American economy started to cool down, which was in part a result of a more restrictive monetary policy by the Federal Reserve, which had caused an increase in interest rates already over the years 1970 to 1920. The stock market became more and more nervous in the course of the summer of 1929 and finally started to collapse on Thursday, the 24th of October. Interestingly, by an intervention of 4 large commercial banks, JP Morgan, National City, Chase National and Guaranty Trust, which bought large volumes of stock, prices recovered the following Friday. But the following Monday, selling began, and on Tuesday a real panic started. The Dow Jones Index lost 30% on Monday and 12% on Tuesday. Stock prices fell from their maximum level of 381 to a level of 198 in a couple of days only. Until April of the year 1930, prices recovered up to a level of nearly 300 again. However, meanwhile, the deterioration of the real economy caused then a steadily slide of prices until the summer 1932, when the Dow Jones Index reached the bottom with only 41 index points. This chart shows the development of the Dow Jones Index after the crash of 1929. First, there was indeed a slight recovery up to a level of 300 index points, but then the real economy has turned into a deep recession such that profits started to fall and prices followed this fall until the year 1933. A full recovery, however, of stock prices took only place after World War II. Until then, there had never been such a sharp and long-lasting slump in stock prices observed. What was most severe was the hardship with which this stock market crisis hit the real economy. Since many people, from businessmen to simple workers, had invested in stock, many people lost net wealth. Their lower net wealth caused a lower demand for goods. People started to save again, which is, taken for itself, quite rational. In the short run, firms adjusted their supply of goods to the lower demand for goods, what led to a further lower level of production. The decrease in goods production caused a reduction in firms' demand for labor. The decrease in the demand for labor led to a tremendous increase in unemployment. Increasing unemployment again led to even lower incomes of the largest part of the population, which caused finally a further reduction in the demand for goods. A typical Keynesian demand-side recession evolved and gained strong momentum. This table shows how severe the following recession was. The unemployment rate rose over a period of 4 years. In 1933, 25% of all American workers had become unemployed. On the other hand, real GDP decreased at double-digit rates over a period of 3 years. All three domestic expenditure components of GDP, household consumption, investment demand, and government consumption, collapsed. Other countries like Germany had similar experiences. So the crisis hit the entire world economy. It was a real world economic crisis. The Federal Reserve did not turn around its restrictive monetary policy in the first month after the stock market collapsed. Only by summer 1933 did the Fed start to switch to more expansionary monetary policy and decreased the interest rates. This timing was, however, much too late. Since many debtors, firms, investment funds and private households were unable to pay back their credits, a couple of banks had to declare bankruptcy. As a consequence, bank runs took place where creditors wanted their money back because they feared further bankruptcies. Since the Fed was first not willing to help these banks with cheap central bank money credits, many banks failed. During the first 10 months of the year 1930, 744 US banks had to declare bankruptcy. By the year 1933, creditors had lost 140 billion US dollar in deposits. The red line of this diagram, the American money supply, shows that immediately after the outbreak of the crisis, the US Federal Reserve strictly reduced money supply. This reduction in money supply cut off many commercial banks from the cash credits they urgently needed in order to react to the bank run of their worried customers. These commercial banks became illiquid and had to file for bankruptcy, even though they were not actually over-indebted. Did the world economic crisis exhibit the typical ingredients of a financial market crisis? Let's start with the initial shock. Most likely explanation for this initial shock that started the speculative bubble are here technological innovations. New technologies, for example, power grid connection of households, electronics, mass production, automotive engineering and the like gave rise to profit fantasies. These profit expectations caused institutional investors to buy stock, which caused an increase in stock market prices. This increase in stock market prices led to an expectation of further price increases. Expectation of further price increases led to, once again, an increase in the demand for stocks, now even by simple households and investment funds. So typical speculative bubble based on this type of feedback mechanism started to emerge. The funding source of this stock market bubble was most likely the extremely expansionary monetary policy of the Federal Reserve and other central banks of industrialized countries. They supplied cheap money credits to their economies, and commercial banks took these credits and supplied cheap credits to households and investors, which boosted the demand for stock. The negative shock here was most likely the gradual cooling down of the American economy in the course of the year 1929, which was caused by a more restrictive monetary policy of the Fed starting with the year 1927. Under the Moodle link of this lecture you will find another link to a BBC documentary about the stock market crash of the year 1929. So much for this lecture.